Every investor makes mistakes, and whether or not they want to admit it, many commit the same errors again and again. So what are the most common investment mistakes, and how can you avoid making them? Our guest on this episode is Joachim Klement. Joachim is a former chief investment officer who now works as an investment strategist at the investment bank Panmure Liberum. He's also an author, and his blog, Klement on Investing, is highly acclaimed. Now, I spoke to Joachim at a very challenging time for investors. The evening before, President Trump had announced his controversial tariff strategy, and markets were in turmoil. On such days, Joachim says it's vital to tune out the noise. He likes to go for a walk.
You spend 10 minutes online to find out what's wrong with the world. You spend 10 minutes outdoors and you find out what's right with it because you're taking a walk in the park or in the forest and you find out how beautiful the planet is.
Also in this episode, Joachim talks about the importance of actively seeking out opinions that contradict your own.
Reading those people gives me a check on my preconceived beliefs.
And he suggests 2 ways to improve your investment performance.
If you want to have an advantage over other people, it is by getting to know yourself better, and improving, constant learning.
Here then is my interview with Joachim Klement. Joachim, your book, 7 Mistakes Investors Make, focuses on the most common pitfalls, if you like, and how to avoid them. To what extent do you think successful investing is actually all about avoiding mistakes?
Well, as Charlie Ennis famously said, it's like playing tennis. In tennis, people like Novak Djokovic win tournaments by finding the winners and getting the best shots to upset their opponent. For most of us who are not professional tennis players, we win our weekend match against our friends by making no mistakes or fewer mistakes than they make. And it's the same thing in the investment world.
I love that analogy. You mentioned 7 mistakes in your book. I'd just like to pick up on 5 of those, if I may. The first one, we think the future is predictable when it isn't. Tell me about that.
I mean, we hate uncertainty. And we record this at a time when uncertainty in financial markets is off the charts, quite literally. And so a lot of people are looking for some sage, some wise man or woman who can predict the future. And if you actually look at the track record of forecasters, it's miserable. It's oftentimes not better than flipping a coin. And in the end, a lot of what is happening in the financial press and in the financial media is just a form of tea leaf reading, effectively. It's something we crave because we crave certainty and guidance, but it's not real in financial markets.
And for those who aren't familiar with behavioral finance, behavioral science generally, why do we crave certainty? And why do we like to think that either we can predict the future or we can find someone to do it for us?
Well, I think the number one thing is uncertainty overloads our brain. It gives us too much stuff to figure out and to work with. And what forecasts do, pretend to do, I should say, is it reduces the amount of mental work that you have to put in. It gives you a clear rule: buy this, avoid that. And the side effect of that is actually that it creates overconfidence, which is a key mistake that people have, especially, if I dare say so, men like you and me. We tend to be more overconfident about our investment decisions than women. And that has been proven for 20 odd years now to lead to lower returns and worse outcomes. Because with this overconfidence also comes a lot of short-term maneuvering in the portfolio where you go like, oh, I know the Magnificent Seven are going to be great, so I invest in Magnificent Seven stocks now. Oh, European defense is going to be great, so I invest in European defense companies now. And so you switch back and forth between different investments, and all that does in the end is erode your returns.
There is a great deal of evidence to show that, as you say, forecasting is very hit and miss, to say the least. There's a famous study by Philip Tetlock in particular. Why is it so difficult to forecast the financial markets and the economy?
Ooh, this is where I get into my favorite topic. It's a complex dynamic system. So by way of background, I'm a trained physicist. In physics, we learn about complex dynamic systems. They're called the weather, for example. And if you watch the BBC News or TV in general and watch the weather forecast, and somebody would come to you and say, oh, in 1 year from now, it is going to be 20 degrees and partly cloudy with rain showers starting at 2 p.m., nobody would believe you. But that's exactly what we're doing in financial markets. It's a massive overconfidence in our forecasting ability. The problem with financial markets is it's millions and billions of people trading with each other, all with their own psychological biases, all with their own psychological ways of interpreting the information that is around. And they do something, they incorporate the information as best as they can, but by the very act of doing something, buying or selling stuff, they change the market itself, creating a signal to themselves. It's what George Soros calls reflexivity. So it's a constant kind of game of intense feedback to ourselves, and it's impossible to predict something like that, except for some very, very simple forecasting rules. So if we go back to the weather analogy, I think there are 3 things we can forecast in the weather. Number 1, very, very short term. Tomorrow, the weather is likely going to be very similar to what it is today. And similarly, if you are in a situation where the stock markets have gone up today, tomorrow they're likely to go up as well. Not always, but in general. The second thing is we've got the seasons. So we know on average, in summer, it's warmer than in winter, and we've got more precipitation in winter than in summer. That's what we have with business cycles. We know when the economy is in a recession, some assets like stocks do poorly, while others like gilts and government bonds in general tend to do better. That's what we can do. And then there's a third one, which I think is the most crucial one for investors, especially retail investors, to follow, is there's one thing that we can forecast reasonably well, not perfect, not good, but reasonably well, and that is the ultra long term. In the case of weather, climate change and climatic changes. In the case of investments, that means that in the very long term, we know stocks may be riskier than bonds, but in the very long term, they are offering higher returns than bonds.
I remember Charles Ellis describing it to me as being like focusing on the climate rather than the weather.
Correct.
The weather is very, very difficult to predict, but you know, broadly speaking, the climate of the country you're going to on holiday, for example.
Exactly.
Before we move on to the next mistake, and it's very difficult, but how do you, as an investor, combat this prediction addiction, as Jason Zweig at the Wall Street Journal has called it? What's the answer to it?
First of all, force yourself to step back from the daily news flow, from your portfolio, etc. I think way too many people, especially those who are interested in money and investments, start reading the financial section in the newspaper or watch financial news on TV, etc. You have to be aware that they're incentivized to sell newspapers and sell ads, which means they have to go for the most outrageous short-term things that are happening today, and then tomorrow it's something else altogether, just to keep your attention. Similarly, social media, same thing. Do not take advice, financial advice on social media. It is the way to ruin. So instead, I would say typically I recommend 2 things to most investors. First, go to a professional financial planner and develop a proper financial plan that works for you, your circumstances, for the long run. Long run meaning 10 years or more. My financial plan is very simple. I am, unfortunately, I have to say, I may look old, but I'm still 18 years away from my retirement. So most of my savings are for my retirement portfolio. And then I have a little bit of an iron reserve or in cash in case there's some unforeseen things. And then stick to that plan. And for me, I mean, I'm a professional. I work in the markets all the time. So I'm confronted with that news all the time. I cannot extract myself from it. But when it comes to my personal investments, I look at them literally only once a year when I have to do my taxes, because then I have to look at them. But that kind of gives me the opportunity to ignore the short-term fluctuations, all the things that are going on a daily, weekly, monthly basis. And at the end of the year, you will find out that in most years, 3 out of 4 years, you're better off than you were at the beginning. And that helps you keep the discipline and stick to your financial plan.
You mentioned short-term fluctuations there, which leads us neatly on to a second mistake I'd like to discuss. And this is that we're too focused on the short term.
Yeah.
Explain that.
Well, as I already mentioned, we are bombarded by people looking for our attention. We are living in the attention economy. And that means a lot of people are coming up with, constant breaking alerts, and this is the new outrageous thing. You won't believe what happened next. Click here. All these things, and the way to do that is by focus on minuscule developments that are completely inconsequential, but blowing them up rhetorically to something big, making basically a mountain out of a molehill. And that is basically creating something that psychologists would call salience. It's kind of like, how real does something feel to me? Inflation doesn't feel real to me most of the time because it used to hang around at 2%, 3%, and we didn't really notice on our every weekly shop that things got more expensive. Only a couple of years later, we all went back like, inflation is when the haircut that used to cost £10 now costs £15 now that you don't have any hair anymore. And it's only that we realize inflation when inflation becomes really big, like we've seen a couple of years ago when all of a sudden 10% inflation, you notice that in your shop. And then it becomes salient, and then it becomes a problem. But most things that really determine your long-term investment success aren't salient. They are not something that changes all the time or very rapidly. It's demographic changes. It's changes in how countries are run, things like that. Inflation depends heavily, as we learned, on global supply chains, and they tend, up until recently, to be very stable over time. And that basically means that the world is such a place where it tries to drag you into short-term noise and keep you away from what really matters.
Now, as you alluded to earlier, Joachim, we're living through a very, very interesting time for the markets. Actually, just now, as we speak, 3rd of April, 2025, last night, President Trump announced a series of tariffs on countries across the world. Yeah. European markets have fallen. US futures are very sharply down. The markets haven't opened yet. But what is the answer on days like this, when we have, a massive news event like this, and the temptation, isn't it, as human beings, is to focus on tariffs. Everyone's talking about tariffs.
Yeah. So the number one temptation is to check your portfolio today. Don't. Block your browser or ask your partner to basically block or change the password and let you into your financial account next week again when things have settled down. Do not, it is natural to think like, oh, how much money have I lost? And then you check and you find out, oh, I may have lost X, and you panic because it's your lifetime savings. And when you panic, you start to make rash decisions, and most often the wrong decisions. Today, everybody is focused about Donald Trump's tariffs. Now, every reasonable person knows that Donald Trump changes his mind on an hourly basis. So whether these tariffs will survive the next 4 years of his presidency is highly unlikely. I'm at the moment doubtful whether they will survive the next month. And then what do? You just kind of whipsaw it from one corner to the other and ignore this stuff until you have certainty. And stay the course in these markets. And ideally, if you can, extricate yourself. Turn off the TV, turn off your social media. Don't check your investment portfolio, because it will make you miserable. And as somebody recently told me, you spend 10 minutes online to find out what's wrong with the world. You spend 10 minutes outdoors and you find out what's right with it, because you're taking a walk in the park or in the forest and you find out how beautiful the planet is and our world is. And that's my best recommendation I can give on days like today. Just go outside, have a wander.
That's a really good suggestion. The third mistake I'd like to discuss with you, we don't learn from history. So what are you really getting at there?
Well, you know the famous saying, people who remember history, people who don't know history are condemned to repeat it, to which I always say, and people who do know the history are condemned to watching other people repeat it. In any case, the thing that we don't learn is we really have, typically as investors, no process in place to learn from our past investment mistakes. And that remarkably is true for both retail investors, common day, everyday investors, and investment professionals. We're constantly kind of making investment decisions. And by the way, not making a decision is also a decision. And we're never going back to check, were these decisions really the right ones? We just kind of move on to the next problem. And something that I recommend investors do is have an investment diary. I have one myself. It's a pretty boring one because it says on the first of the year, kept my portfolio unchanged according to my financial plan. And then a year later, I go back, it's like, good decision. But if you are a bit more active, or if you do something, write down what you did, and then three bullet points. First bullet point, what you did. Second bullet point, why you think it should work out and why. And third bullet point, what is the risk and how could it go wrong? And then when you check your portfolio once every year, you go back and you see in your own handwriting what you have done in the past and what you were thinking at. Because trust me, we are very unreliable in remembering our investment decisions months and years later. And if you have such a review process, you can start learning from your past investment mistakes. You start to see patterns of things that you did wrong in the past, and that helps you to kind of improve, to avoid your own psychological pitfalls. Give you an example of my experience was, I'm German, we're always naturally pessimistic. And I was always really good at selling before markets went down, before I lost money. That's really what I remembered. I was really good, especially before the financial crisis. I reduced my risky assets significantly in 2007. Well done. What I tended to forget and ignore until I started doing investment diaries is that I was completely rubbish at getting back in. So what happened in the financial crisis, I reduced my risky assets in 2007, but I didn't really get back into the market until 2010. And the end result is it was effectively a wash. What I gained by kind of reducing risk on the way down, I lost by not participating on the way up. And And it is these kinds of observations that you kind of allow you to learn from your own history and also learn from market history. You start to understand that most of the time when you have a 10%, 20% correction in the stock market, it's not something that is the end of the world. The world rarely ends. And I have these 10 rules for forecasting, which are in a different book that I've written. And one of them is the world rarely falls off a cliff. Indeed, I would say it happened only twice in the 20th century. That's why we've numbered them. It's called World War I and World War II. Other than that, even look at the pandemic. We did remarkably well.
Absolutely. One more question on history. You were discussing earlier our predilection for looking at short-term noise and paying attention to short-term noise. And generally speaking, even investment professionals are very short-term focused. They look at the last 1, 2, 3, 5 years of returns. But as you say, over the very long term, history does teach us quite a lot. So what do we mean by long term? Should we be looking at 20 years, 30 years, 50 years? How long?
So my common rule of thumb is more than an entire business cycle, which for most people means more than 8 years, but to keep it round numbers, 10 years or more. Everything, and by the way, some of the most successful investors in the world do exactly that. They look at things from a what we call as in the investment professional world normalized earnings and normalized stock market valuations, which try to even out the fluctuations of a business cycle or anything shorter than 10 years. That, I think, is what we should focus on. And then if we get to that, and coming back to the earlier weather analogy, you're in the climate category, not in the weather category. And you're focusing on what's the climate going to be like and how does that influence my personal finances.
Okay, so mistake number 4 I'd like to discuss is we ignore the other side of the story. What's all this about?
Again, if we are trying to make sense of the world, we start to pack it into a story. We try to tell ourselves and other people a story about what is going on in the world. Now, stories work extremely well. As human beings, evolution has turned us into storytellers and story listeners. There are so many psychological experiments that show if you wrap something into a story, people can remember it much better. That's basically how for millennia we've transmitted knowledge from generation to generation. As the older generation sitting by the fire telling the younger ones about how to hunt, etc. The problem with stories is they are black and white, but the real world is never black and white. It is shades of gray. So an example I give in my book is about the tobacco industry, which in the late 1990s were hit by all those lawsuits that were at the time the highest penalties ever paid by any business. And in the 1990s, a lot of people said tobacco is dead. Tobacco stocks should never invest in them because they're basically never going to make money again. While in the 1990s, also a lot of people said Microsoft and other tech companies are forever going to revolutionize the world. And then the 2000s came and over the last 10, 20 years, tobacco did much better than tech stocks until about 10 years ago when the pendulum swung again towards tech stocks. Now today, one of the most commonly touted stories is AI is going to revolutionize the world. And you've got companies like NVIDIA, etc., running high on the expectation that businesses will spend trillions of dollars on AI, and AI is going to be the revolution. Well, there's a cautionary tale called Cisco in the 1990s and early 2000s. So Cisco, for those who don't know it, was basically manufacturing the infrastructure for the internet. cables, routers, all this kind of stuff that everybody needed to run and connect and run the internet. And it was one of the most high-flying stocks in the 1990s. Until people realized that we, number one, don't need to invest that much money into infrastructure because there was technological innovation that allowed to compress file sizes significantly, which gave the rise to YouTube and things like that. You can compress large videos now to such a small file size that you can actually download it on the internet. That essentially reduced the need for IT infrastructure spending to zero. Now, what's going to happen to NVIDIA and its AI chips? Is somebody going to come along and undermine their market advantage by producing a chip that is much, much cheaper, or finding a solution to run AI on fewer chips for much less cost, DeepSeek, that undermines the entire business model and the entire premise of that story. And this is what we always tend to forget, especially for stories that look particularly attractive, that look like the world is going to change.
Because we have this inbuilt confirmation bias, don't we? We actively seek out information which reinforces our existing beliefs. What's the answer to it?
Read wildly and read and follow people that disagree with you or that you disagree with. So I have made it a habit to subscribe to different blogs. Nowadays, everybody's a Substacker or a blogger. From people where I disagree with their entire investment philosophy. Reading those people gives me a check on my preconceived beliefs. It forces me to what psychologists would call cognitive dissonance. Again, staying with the AI example, I read people that are AI boosters, that think AI is going to change the world, and that basically send out a post every month or every week sometimes of another example of how productivity has gone through the roof and that application is going to change the world. And then I also read people like Darren Acemoglu, who just won the Nobel Prize for Economics last year, who has openly said that in his estimate, AI is not going to increase productivity at all or hardly at all. He estimates 1% of growth over the next 10 years combined. So that's 0.1% per year, roughly. And he argues that because AI can only be applied or mostly be applied to jobs that really don't contribute a lot to the economy. Bankers would like to think that they contribute a lot, but effectively most of our economy are people who are in the services industry like retail, leisure, etc., bus drivers. And it really is hard to replace a cook with ChatGPT. I mean, that really is a hard thing to do.
The fifth and final mistake I'd like to talk about, it's rather prosaic in relation to the others, quite simple really. We overpay to invest. Tell me about that.
It's the evergreen. It's the evergreen. Again, people do not focus on what they control and what drives returns in the long run enough. To give you an example, people tend to invest in investment products that have too high fees, where the fees are markedly higher than a low-cost broadly diversified index fund or ETF. And again, because let's assume your ETF costs you 0.2% per year in fees of your invested assets, and your actively managed fund costs you 0.7 or 1.0, something like that. Year on year, you won't notice the difference in your statement. But those costs accumulate. That kind of money that you lose to fees every year is not able to work for you to create more of your wealth over time. And after 20 years, the gap between the low-cost investment product and the high-cost actively managed fund, or even worse, hedge funds and other private investments, becomes huge. And it is like the famous effect of compound interest. It's like, you might earn 1% interest on your savings account versus 2% interest on your savings account. After 10 years, the difference is huge between the two, even though it looks small in the short term.
So that's one of the main reasons, cost. Like you're personally an advocate of low-cost passive investing for the vast majority of investors.
I very much agree with Warren Buffett, who says that 9 out of 10 people, probably more, should just stay with a low-cost, broadly diversified portfolio and not get involved beyond that. And then there are the experts or the Novak Djokovic's of the financial world who try to win games against each other and win tournaments. Mm.
And you've already explained earlier how you like to keep your asset allocation broadly static. You don't like to change things every year. Yeah. Having said that, you work for an investment bank, you work with active fund managers, you advise active fund managers. There are active investors who watch and listen to this podcast. I just want to ask you about something that I know you feel strongly about, and that's that there is a real danger, in your view, in expecting the story of the 20th century, the dominance of America and this extraordinary Buffett has called it the American tailwind, if you like, just to assume that is going to go on forever and ever. Tell me about that.
Yeah, which brings me back to the climate question and long-term trends. Most of the time, the world doesn't change. Occasionally, you come to a situation where the world actually changes. It's the famous Lenin quote of, there are decades when nothing happens, and then there are weeks when decades happen. And ironically, we record this conversation at a time when we might actually be on the cusp of such a long-term change. And I'm not talking about Donald Trump imposing tariffs. We've already covered that nonsense. What, however, happened over the last 3 months is that European governments are waking up and realizing they can no longer rely on the security guarantees of the United States, especially when it comes to dealing with Russia and things like that. So we're now at a situation where Europe is ramping up its defense spending, and where Germany has done something that is really generational. They've put in place a 500 billion euro infrastructure fund, which is 12% of the German economy that will be spent on modernizing its infrastructure. Effectively, defense spending and infrastructure spending in Germany is going to be as much as they spent on renovating the entire eastern German part over the last 30 years. Wow. So it is a proper generational shift. And while we are still in the same climate in Europe of low growth, poor demographics, just more regulation than in the US, which keeps the US economy more dynamic than the Europeans, there is the potential for this kind of decadal change because the Europeans are starting to throw money at the problem. Whether that will turn out to be the correct call, I don't know. But what I'm advocating at the moment is, if you look at the global stock market at this point in time, after the US has done so incredibly well versus Asia, Europe, emerging markets, you're investing in 60-70% US stocks right now. Do you want to be that heavily concentrated in the future of one particular country? Probably not.
If I could just play devil's advocate for a moment, you are extraordinarily intelligent. You are a physicist by background. You talk so articulately in what for you is a foreign language about the most complicated
I've been doing it
aspects
for
of investing.
25 years.
Yeah, that's true. That's true. But it's just your opinion.
Yes.
And the markets are actually very, very efficient because they aggregate the opinions of lots of very intelligent Joachim Klements all around the world. So why should investors give any more credence to that opinion than the broader market opinion, if you like?
First of all, you shouldn't. Going back to our illusion of being able to forecast, that applies to me just like to everybody else. And the other thing is, I think 9 out of 10 people should simply disagree with me. It's like, this guy is talking nonsense when he talks about the revival of Europe, and just stick to their long-term financial plan. What I'm talking about here is stuff for the professional tennis players or the professional investors, where it is always a question of how much does the market really reflect of that trend and how much is new. And as I said, we will find out in the next 5 to 10 years whether I was right or wrong. The other side of the story, to come back to that mistake, is that I've had a lot of professional fund managers who are my clients push back and say, well, these are so far all announcements by the European Union and by the Germans. Not a single euro has been spent yet. What makes you so sure that the money will be spent and that it will be spent efficiently? Which opens up a whole new argument. And my argument would be, I'm not so sure about the European defense package, because that is really something where every country will have to make its own decisions. But I'm pretty sure about the German infrastructure spending, simply because that money is now in the constitution of Germany. And it is, quite frankly, impossible for the German government not to spend it. Whether it will be spent efficiently, that's something we'll have to monitor over time.
Joachim, this has been a really interesting and helpful discussion. I'd just like to wrap it up with some tips, if you like, for viewers and listeners. You've discussed the value of having a financial advisor and particularly a financial planner. Yeah. And why for you is that such a key recommendation?
Number one, because a financial planner is an independent third party who isn't as emotionally involved as you are. So this person can, and a good one always will, be a check on your behavioral biases, on your psychological pitfalls. He or she will actively question your desire to sell this, buy that. Which is why I always emphasize the need to have a financial planner rather than a financial advisor, because a lot of financial advisors work for firms, especially online, that are incentivized by you trading a lot. And that again gets to the cost question. The more you trade, the more transaction costs you have and the more you lose in terms of returns. And no, just because trading costs and transaction costs have come down to almost zero, that hasn't changed. There was just 2 years ago a study that checked on that. No, people still lose money the more they trade. And that is, to me, the number one reason. It's to have somebody who is a consultant for you, who can check your biases and help you become a better investor.
Finally, in the conclusion to your 7 Mistakes book, you say 2 things. 1, get to know yourself as an investor, and 2, keep improving and never stop learning. Why are those 2 things so important?
Because most people don't do that. If you want to have an advantage over other people, it is by getting to know yourself better, and improving, constant learning. Basically, what it will help you do is eradicate one mistake after another. As I always say, it's like we all make mistakes, and we all make mistakes all the time. I am absolutely guilty of that. But my goal is that I would like to make new mistakes just to keep things interesting. Repeating the same mistake over and over is quite boring. And no, it's just basically, if you repeat the same mistake over and over again, then you're just kind of destroying your own financial future. There are plenty of things that will be thrown in your way where you can make mistakes and where you will make mistakes. But over time, as you learn about your biases, as you learn about yourself, the mistakes you make will be less and less consequential.
And as the late Charlie Munger famously said, it's much better to learn vicariously from the mistakes of others than have the hard knocks of making those mistakes yourself.
No, it's. I think we all pay school fees during our lives, but at some point you should graduate and let others pay the school fees.
You explain that really well. Thank you so much, Joachim Klement, for your time. That was my interview with Joachim Klement. We're very grateful to Joachim and to our sponsor, Timeline. Timeline provides best-in-class planning technology and portfolio management solutions that enable advice firms to deliver exceptional value to their clients. If you enjoyed this interview, why not hit subscribe? And if you have a moment, please leave a review or rating, as it'll help us to reach more people. Until next time, goodbye.